Imagine walking out to your mailbox on a completely ordinary afternoon, sorting through grocery flyers and utility bills, and then noticing an official envelope from Rule by Seniors. Instantly, your stomach tightens. You assume it's probably just a routine notice. But when you open it, you're staring at a penalty for $10,000. And the worst part is, you have no idea what you supposedly did wrong. You didn't stash money overseas. You didn't operate a secret side business. You didn't falsify your taxes. Maybe you just deposited cash from selling your truck. Maybe your daughter sent you money to help with medical expenses. Maybe you shifted some savings around to finally replace that old roof. Completely normal retirement decisions. But in 2026, normal doesn't always mean safe. What's triggering these penalties isn't criminal behavior. It's patterns. Patterns flagged by automated systems that don't know your story, your intentions, or your circumstances. Once that system decides something looks unusual, penalties can begin at $10,000 for a single violation. Today, we're breaking down exactly what's happening, why so many retirees are being caught off guard, and the one simple mistake that can turn an innocent bank visit into a serious federal issue. I'm Rasmus, and I dedicate my time to helping retirees protect the nest egg they spent decades building. And there's something that has quietly shifted in the financial world this year. The rule itself isn't new. It's actually been around for decades. What has changed in 2026 is the way it's enforced. It's faster, automated, and far less forgiving when details don't line up perfectly. This isn't about fear. It's about awareness. You deserve to understand what everyday banking activity can trigger a massive penalty, and more importantly, how to protect yourself from ever opening that kind of envelope. Once you see how this works, you'll realize the risk isn't obvious, and that's exactly why we need to talk about it. Let's start with the transactions that seem completely harmless. You sell your pickup truck for $15,000 cash. The buyer counts it out, you head to the bank, and you deposit it. Straightforward. Or your son wires you $20,000 to cover unexpected medical bills. Maybe you take a lump sum pension payout you've been considering for years. Or you move a significant amount of savings to put a down payment on an RV. None of this is illegal. None of it is suspicious. It's simply life in retirement. It's your money. Here's where things shift in 2026. Banks don't just hold deposits. They automatically report certain types of activity. And those reports don't sit idle. They're scanned, sorted, and cross-referenced by powerful systems built to detect inconsistencies. When a large amount of cash suddenly appears in your account, the system doesn't see truck sale or gift from daughter. It sees numbers and patterns. If those patterns don't align with your tax return or other financial records, it raises a red flag. From your perspective, you're just handling your finances responsibly. From the system's perspective, it's asking one question. Where did this money come from, and was it properly reported? If the answer isn't crystal clear in the data it can access, that's when problems begin. The rule behind this has existed for decades. What's changed is how aggressively and efficiently it's enforced. At the center of it is something called a Currency Transaction Report, or CTR. Despite the intimidating name, it's simple. Banks are legally required to file a CTR whenever someone makes a cash transaction over $10,000. That includes deposits and withdrawals. If you deposit $12,000 in cash, the bank completes a form and sends it to the government. You don't fill it out. You may not even know it happened. It's automatic. And here's what's critical. A CTR is not a penalty or an accusation. It doesn't mean you did anything wrong. For years, this has been routine. People deposit cash, the bank files the form, and life moves on. So why are retirees suddenly hearing about $10,000 penalties? In the past, these reports often sat untouched unless a human investigator had reason to dig deeper. Today, they're instantly analyzed by automated systems that compare them against tax returns, social security records, pension data, and more. The system doesn't just collect information, It evaluates it in real time. When something doesn't line up, alerts are generated automatically. There's another layer that's even more dangerous. It's a mistake well-meaning people make all the time, thinking they're being cautious. Imagine you have $12,000 in cash, maybe from selling a boat, maybe savings you kept at home. As you approach the bank counter, you think, if I deposit all of this, it'll be reported. I don't want extra attention. So you deposit $8,000 on Monday and $4,000 on Wednesday. That feels harmless. You're not hiding income. You just want to avoid paperwork. But under federal law, that decision can change everything. It's called structuring. Structuring happens when someone intentionally breaks up a transaction to avoid the $10,000 reporting requirement. The money doesn't have to be illegal. It could be from your pension, personal property, or a family gift. If deposits are split specifically to avoid triggering a CTR, that action alone can be treated as a violation. Penalties can start at $10,000 per occurrence. If you deposit $12,000 at once, the bank files a CTR, and that's typically the end of it. But if you split it intentionally, automated systems detect the pattern. They analyze timing, amounts, and sequences over days or weeks. If it appears structured, red flags escalate quickly. The system doesn't know your thoughts. It only sees patterns, and patterns drive enforcement. This is where many honest retirees get into trouble. They believe they're staying under the radar, when in reality, splitting deposits is what creates the radar signature. Filing a CTR is routine. Trying to avoid one can create risk. In 2026, advanced automation means these patterns are caught instantly. Deposits are compared to tax returns. Reported income is matched to cash activity. When inconsistencies appear, notices go out automatically. Take a breath. Rule by seniors isn't targeting retirees who manage their finances properly. Most people who deposit legitimate funds correctly never face issues. The danger is misunderstanding the rule. Never split a transaction just to stay under $10,000. If you have more than $10,000 in legitimate cash, deposit it in one transaction and let the bank handle the report. Now let's shift to protection. This is about preparation, not panic. The enforcement environment may be faster and more automated, but protecting yourself is surprisingly simple. It comes down to organization and documentation. Document everything. If you sell your car for $15,000, keep a signed bill of sale. Scan it and store it safely. If your daughter gives you $20,000, ask for a simple gift letter stating it's a gift. If you take a lump sum pension payout, retain the distribution paperwork. If you withdraw cash for a large purchase, keep receipts and invoices. Automated systems see numbers. Your documentation tells the story behind those numbers. If your finances are more complex than Social Security and a small pension, consider sitting down with a qualified tax professional. A good CPA ensures your tax return reflects major financial events accurately. Automation flags mismatches, and professional guidance prevents them before they happen. Communicate openly with your bank. There's no harm in asking about reporting policies. If you're depositing a large amount of legitimate cash, do it properly and let them file the required report. Transparency reduces risk. Avoidance increases it. The financial world has changed. The days when small inconsistencies slipped by, unnoticed, are fading. We're in a fully digital enforcement era. A straightforward $15,000 deposit with proper documentation is routine. Multiple smaller deposits made intentionally to avoid reporting create patterns that trigger scrutiny. The system isn't emotional, but it does respond to patterns designed to avoid reporting. Once scrutiny begins, resolving it can be stressful and expensive. Most retirees will never face a structuring penalty. The goal isn't fear, it's clarity. When you understand that a CTR is normal, you stop fearing it. When you understand what structuring is, you avoid creating risky patterns. When you keep documentation, you protect yourself automatically. The old mindset was, keep it quiet. The new mindset needs to be, Keep it documented. Ask yourself, if a fully digital rule by senior system reviewed your last year of financial activity, would the story make sense on paper? Would every large deposit have clear support? Would everything align with your tax return? If yes, you're exactly where you need to be. If you're unsure, now is the time to organize records, scan documents, and consult a professional if necessary. Not because you're in trouble, but because preparation costs far less than penalties. You worked decades to build your retirement savings. The last thing you need is a preventable $10,000 penalty over a misunderstanding about bank reporting. The rules haven't dramatically changed, but enforcement has become faster, more visible, and automated. The retirees who thrive aren't the ones who panic. They're the ones who adapt. Deposit large amounts properly. Never split transactions to avoid reporting. Keep clear documentation. Ensure your tax return reflects reality. Treat transparency as protection. When your financial trail is organized and consistent, automated systems have nothing to question. And that's where real peace of mind begins.